Welcome back. As we saw in our first video, management has primary responsibility for the financial statements. We can view the balance sheet as management asserting this is the financial position of the entity. The income statement as asserting this is the financial performance of the entity, and the statement of cash flows as asserting these are our cash flows. The auditor's job is then to verify those assertions that management is making. The auditor does this by disaggregating the financial statements into the transaction cycles, as we saw in the last video. The next step is then to disaggregate the account balances and transactions into their underlying financial assertions. It is the assertions that the auditor actually audits or verifies. So, we will now address our fourth learning objective, which is to state the categories and types of management's financial statement assertions. Number 5, which is to link management assertions to specific audit objectives. And number 6, which is to explain the relationship between audit objectives and the accumulation of audit evidence. ASA 315, Identifying and Assessing the Risks of Material Misstatement Through Understanding the Entity and its Environment, another long name, is a very important standard and one that is central to the audit process. We will be referring to it frequently in the coming weeks. It is ASA 315 that requires auditors assess the risks of material misstatements at the assertion level. It divides the assertions into 3 categories. Those assertions about classes of transactions and events, those about account balances, and those about presentation and disclosures in the financial statements. Let's now look at each of those 3 categories in turn. The assertions for transactions are occurrence, completeness, accuracy, and classification and cut-offs. Occurrence means that the transactions actually occurred. That is, that they are real, genuine transactions that actually happen to the entity. All transactions that occurred have been recorded in the accounting system, so that's completeness. And those transactions have been recorded at the correct dollar amount, which is accuracy. And they've been recorded in the correct account, classification, and they've been recorded in the correct time period, which is cut-offs. The assertions for account balances are slightly different. When we talk about balance sheet accounts, we have to verify their existence. Existence is the equivalent of occurrence for transactions. So we said the transactions are real transactions that actually occurred. For balance sheet accounts, we mean the assets, liabilities, and equity of the entity are real, genuine assets and liabilities that actually exist. Completeness is the same meaning. So here it's all assets, liabilities, and equities that exist have been included in the balance sheet. It's a complete record of them. The equivalent of accuracy for transactions is valuation and allocation for account balances. Unlike simple transactions, where there's typically a known dollar amount that can be verified, asset valuation is much more complex and subjective due to impairments, write-offs, the use of fair values, the application of depreciation, amortization, and any related provisions or contra-asset accounts, such as, for example, the provision for doubtful debts. So there's a lot of work for auditors in verifying valuation and allocation assertion for balance sheet accounts. Finally, rights and obligations. This only relates to account balances as it deals with the legal rights associated with assets, so the claims of the entity embodied in its assets, and the legal obligations that the entity has in respect of its liabilities and equity interests. Our third and final category of assertions relates to the auditor verifying how management presents and discloses financial information in the final financial report, which includes verifying that all of the disclosures in the notes that are required by the law and the accounting standards are there and that they're complete and presented appropriately. So let's look at an example of how we apply assertions in practice. Let's take an account, balance sheet account, inventory. So in the unaudited financial statements, there's a line item in the trial balance saying inventory 1 million. If we're auditing this, the simplest thing, of course, is to say it's about checking the numbers. Well, is that $1 million the right amount? Is inventory fairly stated? Is it actually worth $1 million? That, of course, is our valuation assertion. But that's not all we have to do as auditors, because that's not all that management is asserting about its inventory. So it's asserting that inventory is worth $1 million, that's its value, but it's also asserting that that inventory is real, that it exists. So that's our existence assertion. What else is implied? Well, management's asserting that this is the sum total of all of their inventory. So all inventory is included in the balance, in other words, that is completeness. Then because it's an asset account, has future benefits, the entity has legal rights, there is the assertion that the entity owns the inventory and the benefits that are going to flow for it. So that's our rights and obligations assertion. And then finally, in presenting the financial statements, that all appropriate disclosures have been made in the financial statements. So that's our presentation and disclosure set of assertions. So this is not just the disclosures, of course, that are made on the face of the balance sheet, but it's all of the related information about inventory, methods of valuation used, and so on, in the notes supporting the inventory account. So in auditing any area, it's more than just simply, is the dollar amount right? The auditor has to be able to verify all of management's assertions to be able to sign off that that particular account balance, as we've seen here for inventory or transaction class, is fairly stated in the financial statements. So in order to meet our overall audit objective, which remember is to provide assurance in our audit opinion about the financial statements as a whole, we have to meet a whole bunch of more detailed or specific audit objectives. Now, there's nothing magical about specific audit objectives. They're simply about verifying the assertions in those three categories of assertions that management makes. So what the auditor does is to use audit procedures to gather and evaluate audit evidence, and that evidence is used to then verify that all of those management assertions are in fact fairly stated and not materially misstated. In our next video, we'll focus on those audit procedures and audit evidence.